Discover why the Federal Reserve's latest decision to hold interest rates could have profound implications on your investments. As markets react unpredictably, are you prepared to navigate this financial storm? Let's explore how these changes might just reshape your economic future. Welcome back to our channel, where today we delve into the complex world of economics, focusing on the Federal Reserve's latest actions regarding interest rates. With economic giants like Dalio raising alarms and the bond market experiencing unprecedented shifts, understanding these dynamics is crucial. We'll discuss how these decisions impact the broader economy, influence investment strategies, and ultimately affect your financial well-being. In this video, we will dissect Jerome Powell's recent statements, explore the collapse of the bond market, and assess the stock market's recovery. We'll also discuss potential investment strategies in light of these economic conditions. Whether you're invested in stocks, bonds, or just curious about how these changes might affect you, we'll provide insights to help you make informed decisions. Let's dive straight into the recent economic developments that have everyone on the edge of their seats. Jerome Powell, defying pressures from President Trump, has kept interest rates unchanged. This decision resonates amidst one of the wildest market scenarios of our time, prompting pivotal questions about our economic future. The bond market has seen unprecedented declines, reminiscent of crises long past, as higher interest rates have led to severe devaluations. Meanwhile, stock values have rebounded near record highs, defying logic amid escalating global tensions. The U.S.'s relentless currency printing spree also adds to the complexity of this landscape, with experts like Dalio warning of looming economic turbulence. In today's video, we'll explore the implications of Powell's interest rate stance, the potential for further bond market collapse, the risks of jumping into stocks at current valuations, and importantly, what all these mean for your financial strategy. The crux of the Federal Reserve's decision to maintain current interest rates boils down to inflation, as indicated by the Consumer Price Index, CPI. Although the CPI showed a tepid increase, largely attributed to a drop in energy prices contrasting with a rise in housing costs, it does not paint the full picture. Current inflation levels may appear manageable, but there are underlying concerns. Businesses' pre-stocked inventories are absorbing tariff impacts, potentially delaying visible inflation spikes. Meanwhile, core CPI, unaffected by volatile sectors like food and energy, shows stubbornness at around 2.8% over recent months. With oil prices on the rise, there's a substantial risk of inflationary resurgence. This complicated backdrop renders the bond market's reaction particularly noteworthy. As interest rates ascended, bond values plummeted due to newly issued bonds offering higher yields compared to existing ones. This spurred significant losses, pressuring financial institutions and impacting government debt perceptions. Amidst these financial intricacies, what does the future hold for investors in stocks and bonds? The bond market's current pessimism presents a potential opportunity, given the attractive yields unseen in decades. On the flip side, stocks at historically high valuations might be overestimating optimism, suggesting a future shift toward bonds might provide lucrative arbitrage gains. Yet one must remain cautious of potential pitfalls. External factors such as tariffs, geopolitical tensions, and domestic fiscal policies weigh heavily on economic prospects. For investors, safeguarding wealth extends beyond mere earnings. It involves strategic financial management and credit optimization, a sector in which Kickoff excels as a credit-building service. As we examine future rate directions and economic strategies to navigate this uncertain terrain, it's crucial to maintain informed and agile investment practices. No crystal ball exists, but a diversified, strategic approach remains your best defense against financial volatility. Looking ahead, the Federal Reserve's stance indicates a cautious approach to rate adjustments, likely postponing cuts until signs of persistent inflationary pressures wane. The expectation is that interest rate reductions might start as late as September, provided international tensions, such as those in the Middle East, stabilize and don't disrupt economic recovery efforts. Meanwhile, the larger global economic picture remains convoluted. Talks with China and efforts toward Middle Eastern peace may provide respite. However, emerging challenges such as potential supply shocks and volatile commodity prices, especially oil, remain ever-looming threats. Moreover, employment metrics, blurred by broader definitions and underemployment, further complicate the outlook. As investors and analysts alike grapple with these complexities, one thing remains clear: maintaining vigilance, adapting to shifting narratives, and strategically managing investment portfolios will be crucial in steering through these tumultuous times. Share your thoughts and strategies in the comments, and remember to like and subscribe for more insights. Today, we've explored the Federal Reserve's decision to maintain interest rates, the repercussions of the bond market collapse, and what experts like Dalio are saying. We've also looked at potential investment opportunities amidst this economic volatility. Understanding these elements is key to navigating your financial journey in times of uncertainty. What are your thoughts on the Federal Reserve's current stance on interest rates? Do you agree with experts like Ray Dalio about the state of the economy? How are you planning to adjust your investment strategy in light of these insights? Let us know in the comments below. And as always, if you enjoyed this analysis, please like the video and subscribe for more in-depth discussions.